Sridhar Sivaram, good morning. Thank you for joining us. Should one feel happy that markets have not corrected in accordance with the macro, or we should not get complacent, a correction is about to come?
Well,
speak your heart out today.
No, I'm actually, I normally speak what I actually believe and land into trouble many times. But I'm actually not so bearish on the market.
Okay.
And relative to what other emerging markets have done, India is actually standing out. It's one of the big outperformers. Even if you compare the larger markets, take China, Korea, Brazil, Russia, Indonesia, South Africa. I'm not even comparing Turkey here, but India is down 7-8% in dollar terms, MSCI, and emerging markets are down about 15%. So, given all the negative vibes that we see in the newspapers and in generally in media, the actual market performance relative to its peer has been a standout. So I think we have to see that in that context. Even the currency, I'm not an expert on currency, but I track the RER on a close basis. That number for last month is somewhere in the 110 range, where 100 is the normal. So it is relative to what other currencies is what we have to see. Currently the focus is only on one currency. So I'm not so perturbed. Yes, if there is a sharp movement in currency, we have a lot of other issues which come up. But
this is a sharp movement in the currency, Sridhar.
Well, it is sharp movement relative to only one country. But if you look at all the emerging markets, it isn't a sharp movement. Our RER still is 110.
Okay, so my counter argument is, how does that matter? What's happening with the other countries?
Oh, it does matter because we trade with all of them.
Are we going to be
no, so RER is calculated based on your trade weighted, right?
Okay.
So you are trading with Europe, you are trading with other countries, you are trading with China. So it is not we are trading, our trade is not 100% to the US. So this number is calculated based on what your trade is with other countries. So I think it does matter. And if we continue to appreciate as we had, so this RER had gone over 120. How can you compete if India wants to improve its current account deficit? How does one improve the exports if we are so uncompetitive with some of the other countries? So I think it's relative to what other countries are. And I don't think a measured depreciation is bad. I agree that if we get sharp depreciation, it does cause some concern. And typically we've seen in the past also currency depreciations don't stop at fair value. They typically overshoot and then they come back. So I won't be surprised if we see some action from RBI in the very near future to control this, this currency movement. But in my view, this isn't as disastrous as it was in 2013. I mean, we had current account deficits over 5%, our inflation was double digit. We had a lot of issues then. This is looking much better now than it was in 2013, and it is reflecting in the market. That's my point.
But that's the now. What happens from here if crude continues to spiral up, currency continues to weakness? Because up until now, you've not seen much of an RBI intervention, purely because I guess they're also looking at it through the same glass as you, that on a relative basis, we've fallen a lot less. What happens then? And more importantly, do you have valuation comfort in this market?
So, firstly, on what happens if crude continues to go, obviously, if crude goes to 100 and in 2008, we saw 150, then a lot of bets are off. You're not assuming that those sort of numbers will be seen, because the country that, or a few countries which get impacted most because of those sort of events is obviously India. So then one has to relook at it. One is assuming that even at where it is today, obviously it is bad, but my point is it is not as bad as it is made out. But if it continues in this trajectory, obviously if currency also moves along with crude, then we have double impact. In my view, the currency, large part of the currency action is done. I'm not an expert on currency, but based on what I read and looking at RER, it looks as if we are at a zone.
The worst is behind.
Yeah, the worst is behind. Currencies normally move a bit more than where fair value is. Crude, I really can't comment. It's very difficult for anybody to comment on crude. It depends on what Trump decides to tweet and what happens after that. I would assume it doesn't hurt, it hurts every economy if the crude continues to go this way. So my base case would be that crude is not going to 100. If it goes to 100, then a lot of bets are off.
You know, one of the standout features for this market has been that domestic flows have been strong, FII flows have been shaky. So we've got lots of questions for you, but on a daily basis, We are now running a sort of data for our viewers where we are trying to identify FI dominated stocks. We did that for some of the large and semi-large cap stocks yesterday, and today I'll expand the list slightly further. Vivek is going to expand that list slightly further. So Vivek, very quickly, tell us the BSE 500 stocks where the FI concentration is very high, and then I'll get then I'll get a reaction going on that.
Well, that's right, Nikunj. Nikunj, yesterday we told you about how in the last couple of years the DIFOs has been something that's actually aided the market up move, and the fall, the relative fall that the Indian market as well as the Indian rupee has seen has been a very balanced fall compared to the rest of how its Asian peers were falling. Remember yesterday, the Chinese market actually went into a technical bear territory. But, to carry on the series that we started yesterday, we spoke about how in the Nifty 100 companies, some of the stocks that had a large FI holding that was susceptible to FI selling or large selling scene. Today we are carrying it forward. The Nifty 500, some of the names, high beta names, PVR, Apollo Hospital, Magma FinCorp, all of them almost over 50%. Some of the other names, Himadri Specialty Chem, NBFCs, FMCG companies, these are some of the names, and IT companies, these are the names where FI holding is typically the largest as far as India is concerned. Moving on to the Nifty Mid-Cap Index, if you're looking at some of the names, some very interesting names out here, IDFC, Edelweiss, M&M Financial Services, Max Financial Services. So a lot of names in the NBFC space, the financial space, these are the ones that could be susceptible because of the fact that the FI holding in them is almost over 30%, and these are the names to watch out for in case there is an exaggerated FI selling as far as India is concerned.
Sridhar, the liquidity or the global liquidity is where I like to get your thoughts.
Right.
The general view is that the approach towards emerging markets could be slightly stepmotherly. And India is just a market where foreign investors have allocated.
Right.
If the sentiment towards emerging markets gets sour, you will obviously have a ripple effect of that on India.
Yes, sure.
And if you're a foreign investor, you will sell what you own. And largely foreigners own private banks, NBFCs, and they own a lot of consumer names. Are those pockets in the threat?
See, some of the overvaluation sectors where we've seen, extreme. So we've had a very polarized market. We've had, maybe 15-20 stocks which have got re-rated for last 5-6 years, and then we have the rest of the large cap. As Aisha mentioned, is there valuation comfort? I do see valuation comfort because outside these 15-20 stocks, if you dare to step into the others, then there is enough value available. I'm normally a growth. I have a normal growth bias, but I do find companies which are growing and yet trading at fairly reasonable valuation. So after what we've seen, even though the markets are closer to its high, the broader market and even some of the larger cap stocks are way off their highs. So I'm not so worried that because they'll be selling from FIIs that I will not look at stocks. I think flows can take the markets up or down only up to a point. It is the earnings and the stocks are slaves of earnings. So if the companies are going to deliver earnings, I'm really not worried based on short-term stock price movements.
So please enlighten us. Where is it that you're finding this value zone across mid and large caps?
Yeah, so I've met so many companies over the last 60 days because post results and conferences. I'm surprised that across the board, domestic companies have been guiding so strong. In fact, one of the staple companies was on the conference podium said he hasn't seen such strong growth. Last he saw was between 10 and 13 when staples were growing at 10-12% volume growth even for the large cap. From consumer discretionary to media, I mean, there is a media company which is a large cap whose earnings are going to grow at 70% over the next 2 years and trading at absurd valuations. There are companies that we saw on the consumer discretionary and durable side which trading at one-time sales. I'm not here to give names, but I'm just saying that these are consumption-related stocks with no corporate governance issues, which have corrected significantly because of market movements. And I'm seeing enough opportunities across sectors, but my focus right now is more on the domestic because that's where I'm seeing the momentum.
So the bottom line here is that you are you are a buyer in this market. You are using the decline to your advantage. Macros are important, macros are crucial, but the macro headline is not forcing you to either sell or sit on cash. You are using this decline to buy. Now what you buy is a judgment call, that's a stock specific call, but in general your mood is that better days are coming and poor macro will not derail the economy and the market, at least in next earnings next 3 to 6 months.
So our broader call is that micro has significantly improved, and we did a lot of analysis on why is it that even though the macro is deteriorated, why is it that company after company is telling us that we are seeing very strong growth. So in our view, if you give me 2 minutes, in our view, there has been a fiscal stimulus which has gone completely unnoticed. So if you take the GST cuts starting from October of last year, if you add all the GST cuts in terms of value, what is the cut, what is the loss to the government, that adds to about 50,000 crores, roughly ballpark. If you add all the loan waivers, that also adds to about say 70,000 crores. There's one more, we're looking at money in the hands of consumers. So one of the other interesting points we noticed was the telecom sector has shrunk from about 250,000 crores to about say 2 lakh crores because of the geo effect or whatever. Now
you're talking about the market cap.
Yes, no, this is the market size. The revenue of the sector has shrunk by 50,000 crores.
So you're saving because of your telecom.
So where has this 50,000 crores gone? All we're trying to say is, why is it that people have more money in their pockets? It doesn't matter to you and me. It may matter to somebody on the ground who is earning.
Diesel prices. You've not got a tank full.
No. So I'm just adding a lot of things that why is it that somebody from a Domino's to a Pizza Hut to a Pantaloon to a Shopper Stop to a Big Bazaar to a Staples company which is large to small to a tractor manufacturer to a CV manufacturer to a cranes manufacturer to a construction equipment manufacturer, all are saying the same tune.
Exactly.
It cannot be that something hasn't happened on the ground. I've never seen where so many companies of different sectors are saying, hey, demand is so strong. I don't have capacity. These are things I've not heard before. So all I'm trying to say is that there has to be some reason. What could it be? In our view, there's been a fiscal stimulus. You can add fiscal stimulus in this way, or all I'm trying to say is that more money in the hands of people, in whichever way you want to add. This could be election effect because we have an election 1 year down the line and the government is smartly doing this without media really catching on to this. But the point is that I'm hearing this from large section of domestic companies. How can I be bearish when so many companies are telling me that, hey, I'm going to grow 30%, I'm going to go 40%. These are not numbers I've seen in the past. So one has to be cautious. One has to look at, the corporate governance angle. What is the history of these companies? Have they managed their debt well or not? But my broad point is there is enough opportunity given the carnage that we've seen. So from a valuation standpoint, my starting point is great because I'm not buying many of these. And so I'm not looking at the ones which are already trading at 50, 60 time valuation.
Right.
Maybe I look at them from a sector standpoint to understand whether they are seeing growth or not. But the stocks that I have to pick is from this basket which has got killed.
Okay, you spoke about corporate banks that you're bullish on. Is transition good news for these banks because a lot of them are going through that?
Yeah, so I think one of the result of all these changes that we've seen and one of the reason for us being very bullish on the corporate banks, and it hasn't exactly worked the way we've thought because we've been bullish for almost a year now, is that we think IBC is a game changer. I've seen the markets since '94 and I've seen the same promoters, default and come back and, take loan and again default. At least I've seen 4 cycles and this is going on. The first time we are seeing promoters actually fear that they lose their business. So even though IBC hasn't kept its timeline, I do think that because of IBC and the fact that a large part of the problem is now known. Like 3 years back, we used to always go and question banks that, listen, we think this is your NPA, but you're showing X. I think that discussion is now stopped. Now the discussion is more how much more provisioning is left. And if you see the last 2-3 years, the credit costs for most corporate banks have been in the range of 2.5–3%. That's fairly substantial only for the last year, and they've had similar numbers for the previous 2 years.
Will that make a case for looking at PSU banks?
It does. So we're not saying all PSU banks, but if
But
you
that's the story
assume
each
that a
time.
normalized credit cost is say 1%, even if you take 1% as a normalized credit cost, you're going to see 200 basis points of credit cost savings. And that is substantial when it comes to earnings. So I don't think anybody has the guts to put those numbers on spreadsheet because we've had wrong calls for the last 3 years. But I think we are very close to the end, and maybe in the next 2 years we'll see. So I would say corporate banks is a 18-month trade for me, where I can see that this earnings growth will come.
Not an investment.
Not a long-term investment, because you know how PSU banks, over a period, you cannot really say that PSU banks, I will hold, like say an HDFC bank, you can hold it for a long period of time, but surely not a PSU corporate bank. Some of the other corporate banks where we are seeing management change, those are interesting. I mean, that's an option worth looking at. But for the PSU side, I think it's a trade.
Why is Reliance moving up the weightage? What is the right way to look at Reliance? I mean, it's India's biggest market cap company. So I'm not getting into stock specific.
I'll not comment on individual trade, but they also have technical stuff in favor because both FIs and domestics have been underweight. This has been a reason for many of the funds outperforming, because for almost 10 years they hardly performed. And for the last 2 years, a large market cap moves, then it hurts a lot of funds.
So 3 years from now, I'm saying, okay, let's say 3, 4, 5 years from now, what is the right way to look at a company like Reliance, an oil and gas company, a company which will be oil and gas plus an telecom company, or a company which was an oil gas company, has telecom business, but now has become a retail and a technology company? Is that a safe migration to look at Reliance from 3, 5 years?
Whatever they do, most companies, I will look at cash flows.
Okay.
Can I see cash flows 2 years down the line?
That's the point.
That's my answer. I don't want to, get deeper into whether I like or I don't like Reliance. I don't want to get into that. If I see cash flows, then I think it's worth looking at. If the cash flows are just a dream, then this won't last for too long. That's all I can say.
So I want just one very quick follow-up question. So I won't ask you on stock. Let me ask you on a group. The SEBI rules are very separate. The restrictions are not there, or the restrictions are there on stocks, but there's nothing on group. Okay. Do you think Chandra is trying to do the right thing by rebooting Tata's, because he's trying to change the capital allocation? The word which he's using is not operating. He's using operating leverage and cash flows. So from a market standpoint, can some of the Tata Group companies 3-5 years from now be go-to companies?
So to be fair, even his predecessor was doing exactly the same. Okay. So I'm not differentiating between what Chandra is doing and what the earlier predecessor was doing. I think that is the right way for the Tata Group, because their issue post 2005 onwards has been that they've had very poor capital allocation. They've acquired many companies overseas, and they're struggling with many of them. If they can do that, and it is not just the Tata Group, any group, if you see, if your capital allocation is good, your re-rating is substantial. So I think it's a normal mantra that you have to follow, and that's something which we always look at. So if capital allocation is poor, you just run because you know it's going to hurt you at some point.
Okay, Sridhar, very quickly, we have just 1 minute to go.
Sure.
How do you capital protect? Do you now book out of IT and Pharma? Has that trade lasted way too long?
So I'm not a bull on IT anyway, okay. Because I think the currency trade never plays. So you go back 8-9 years back, currency was at 45. Today we are at 72, 73. Margins of these companies are lower than where it was when the currency was at 45. So this is a myth in the market that currency buy pharma, buy IT. Some pharma companies have benefited. So these are very stock specific. I'll not take sector bets on this, especially on pharma. IT with no top line growth, I mean single digit top line growth, I can't see any momentum, so much of disruption happening in their sector. Unless these companies can really change themselves and actually disrupt themselves, I don't see a structural trade here. So this year is an aberration because people are hiding, but once people start coming out from the hideouts, people will look for other sectors.
So I'm glad that you managed to come out of this hibernation after 8 weeks now, and hope to see much more of you.
Sure,
and thank you for joining us.